Hello and welcome to the Delaware Mortgage Rate Report for the week of December 5th. I'm John Thomas with Primary Residential Mortgage. Okay, today, this week, we have on tap, last Friday was the big job news was reported and the unemployment rate was down to 8.6%, but there's some conflicting information in the report because that does not include the people that have stopped looking for a job. Economic calendar this week is light, so the big market mover is going to be news coming out of Europe. And we actually did have some news from the Italian Prime Minister. Said he's planning on rolling out a proposal to lower the country's debt, which happens to be the second largest in the European Union. So stocks have been trying to rally on anything good coming out of Europe, hoping they'll fix the problem. Problem is there's no quick fix. For example, the plan for the Italian sounds like bring back a tax on first homes and enforce tax evasions. $30 billion, that sounds like a small number compared to a $500 billion debt has to be refinanced in the next 3 years alone that the Italian have. So they're trying to do some austerity measures, cut back on social programs, stuff like that, but we'll see what happens there. Mortgage rates have been holding up pretty good because of the belief that the Federal Reserve is going to do the third round of quantitative easing, which means buying mortgage-backed securities. Let me see here. We've got, you can see the bond market. Right there, we've been holding at a line of support. We won't go below that. That is basically hoping that the Feds do start buying mortgage-backed securities. If that happens, we could see rates tick down slightly lower, but rates are still at all-time historic lows, so it's a great time to purchase or refinance a home. If you're a first-time home buyer, don't forget the next free first-time home buyer seminar is December 17th, which is a Saturday, in Newark at the Christiana Hilton Hotel. What I'm going to do right now, if you have a mortgage that's closing in the next 7 to 10 days, I'm going to say go ahead and lock your rate in because we could have some short-term volatility. Don't see the rates going much lower until the Feds actually start QE3, the quantitative easing third round. But there is a risk that the rates could rise slightly if the stock market rallies on any news coming out of Europe. So I'm going to go ahead and say lock in if you're closing in the next 7 to 10 business days. If you are 30 to 60 days out, you can go ahead and float. There will be some volatility, but go ahead and float. You may end up getting something slightly better, but not too much risk to the downside. Well, that's it for this week's Mortgage Market Guide. I want to thank you for watching, and I'll see you next week.